Sunday morning, once again, time for another weekly market recap. A little bit of a spoiler, it's probably not going to be an hour long, luckily, because I'm super busy. Nothing to be worried about. It's just family related business, and it's all good news. All right. We are going to have a major family roundup in just, I guess, 3 hours from now. My brother-in-law, he got a baby just this week, so I've been very busy. I mean, the whole family is all ripped up and thrilled, of course, because of the newcomer. So a lot of positive news, a lot of reasons to be celebrating, but of course it's gonna drain away energies and focus and attention from the markets. And as a matter of fact, I basically stopped trading and following the markets on Thursday this week when we got the news that basically the baby uh, have have come in. So let's try to make this quick. And let's look at the economic calendar as usual. Now, what you see is been a particularly eventful week, and as usual, the juicy stuff where at the end of the week. But before diving into the economic calendar, let's of course address the elephant in the room, right? The market was shaken out by the events in the Middle East. And I have quoted the Middle East a lot, basically in all my videos, especially when I was talking about oil. And now, look, I'm not going to take sides because, of course, that's not my role, especially if I want to stay in this more of a public way on the internet. I got my opinions, of course. Who doesn't? It's just not. I just think this is not the place to discuss that sort of matters. It is a topic which is particularly emotionally charged, and I really don't want to provoke undesired reactions, or as I always say, people tend to get offended really quick these days. So I'm not gonna trigger you. You're free to have your own opinions on who's the bad guy, who's the good guy, and whatnot. I'm just gonna say that when it comes down to markets, of course, news like that they can move prices, but at the same time, it's particularly interesting, and we're going to look at it, especially talking about oil. um, the no matter the news and no matter how the news actually come in, the markets are always a little bit kind of forward looking, right? They might not move as you expect, or they might not move right when the news are released, but they start to manifest signs, a little bit of evidences here and there, and we're going to look at it in a minute. So, of course, this was beyond the macroeconomic data points. This was, I guess, what really moved the market this week, especially some markets. But other than that, um, the week was particularly positive as for the data which came in. As you can see in here, we got inflation data from Europe were in line with expectations, if not a little bit lower than expectations. So as we've seen last week with what was that, Spanish, French CPIs and whatnot, it's still disinflation all across the globe, at least for the major economies that we can follow, right? And the data, especially related to the labor market from the US, were positive. You can see, I don't know, JOLTS was above expectations and it was above the previous data point. ADP was above both of previous data point and expectations, and the NFP they surprised massively to the upside. Now again, do you want to believe these data? Do you want to keep on bringing on the narrative that the books are cooked because it's election year? We are at this point we are like 1 month till the election, so yeah, again, a lot of don't want to call it conspiracy, but people are legitimately or maybe not legitimately thinking what they think. The problem is, as usual, that no matter what you think, no matter what I think, the market is going to move on these headlines. So that's why you're checking what it's coming out from this chart right here, right? Now, let's have a look at markets, and then we're gonna get back to it a little bit later, all right? And let's start out with currencies. Now, again, as you can see, the DXY had a little bit of a bounce just when it was looking like it was about to break down. No, absolutely not. It danced around this macro range once again, and then it just went higher. I mean, it is still in a relatively weak position compared to the downtrend originated in June, but could this be a start of something? We'll see. I mean, I don't have a clear opinion on that at the current moment in time. For me, right now, it's just a normal pullback, And again, we were looking at it and we were saying, you know what, when it gets back to these lows and you don't see it really going and breaking down, it might be that you're going to have a little bit of a counter trend reaction. And that's what we got now. Again, is it because what happened in the Middle East? Could be. I mean, surely it might have an impact on price action and currencies, of course. But I think it's a little bit of both, right? There is the component of the war in the Middle East, and then, of course, other markets dynamics. Um, that's what you got. And of course, conversely, the other currencies, the foreign currencies like the euro, the British pound, and the yen, they all pulled back violently this week. Now, again, I guess the most important one is the yen for all the implications about the carry trade and whatnot. I think that the risk of the carry trade unwinding it is still present, right? Of course, but at the current moment in time, I wouldn't put a lot of emphasis on it. Uh, as I mentioned previously, as long as the movements are particularly slow and ordered, you don't expect markets to be really impacted. All right. So currencies look particularly fine for now. I mean, it depends on your disposition, right? If you were bearish the DXY, you got a surprise. If you were particularly neutral over a long period of time, like I was, I mean, if you look at this range, which is plotted here, this range is just gone on and on and on and on for months now. So, you don't really expect something new up until the point this range is actually broken and possibly retested, confirmed broken, and price is auctioned to new levels. But, being a macro range, it's going to take maybe weeks, months, who knows, right? Now let's check gold, and there is really nothing to say about gold. It was just ranging behavior. Compared to other charts, it looks like it really, it even didn't move it so much, right? It just stayed in this consolidation once again, which it seems to be the pattern, right? A slow grind to the upside. It has these 3 4 days of a pump, and then it consolidates again. So it's still bullish behavior, right? Sideways up, sideways up, sideways up, sideways up. And, it's a particularly efficient market so far. Again, uh, sooner or later it's going to pull back violently, or, to a much greater degree compared to what people might expect after seeing basically, what was that, April? So what, 6 months at this point? After 6 months of these, you would expect these to go on and on and on into the future. But we do know that at a point, markets will have to pull back, mean revert, and all that type of dynamics. So just, you ride the trend until you got a trend, and it's going to be the market to tell you when the trend is actually kind of shifting. Um, If you want my complete or much more elaborated view on gold, just get back to last week episode, and basically that's the same. Nothing changed because the chart didn't change. Uh, we still got a little bit of an issue with positioning, I think. I mean, people are massively long gold at this point, so it could be that at a point those people are kind of caught, right? Uh, it's always like that when you got a massive amount of people all to the same side of the bus or the boat or whatever metaphor you want to use. So be on the watch for that, but at the same time, don't lose your sleep over it because I just mentioned that because that's what we basically got in oil. You remember, it was last week and mainly 2 weeks ago, I was saying, if it fails to have continuation to the downside, considering the positioning and the sentiment on this asset, everyone, myself included, of course, over a long period of time, a bit more a medium to long time, longer time type of view. I'm bearish oil for fundamentals reasons, right? Everyone was short, or at least the positioning. If you look at the commitment of traders, there were a lot of short position. The open interest on the short side was massive, and of course with what went on in the Middle East, with Israel basically now having to respond, having a little bit of a retaliation against Iran for what happened just this week. Um, the I guess the market is trying to price in the potential risk of an Israel attack on the Iranian oil facilities, which is why you've seen oil doing that type of movement to the upside. But again, this is the easy explanation, right? But was it? Right? I mean, was it really like that? It's all about what happened. Because again, the positioning and the lack of continuation to the downside, these two alone, they were giving you clues about what was the risk of a spike. Well, I mean, spike. It's if you look at this as just this segment of price action right here, it might look like a spike. If you zoom out, really, is it a spike? I mean, I don't really know. Like, you could call it this a spike, right? You remember when we got Russia, Ukraine, but these for now, I don't know. I mean, to me, it doesn't look like panic. All right, it just looks like it happens all the times. There is a good opportunity to be long because everyone is short. And if all the people which could have sold have already sold, when the last seller sells, who remains in the market? Buyers. And since you got a little bit of a cascade of a short closing, that's what you get. A little bit of a sharp pullback, which for now stopped right into the previous apex. We got a little bit deeper, I guess. And if you remember that Fibonacci type of a retracement that I plotted, we are still in here. Now, considering this dealing range, we are now at a premium, so it remains to see what's going to happen next. If we got a little bit of a rejection off of these levels, it could resemble maybe something like here, like these, right? Or, and I think if I had to place a bet, or a little bit of a choppy action at these levels before making up his mind. I think the latter is the most logical type of uh, price action you would expect to see going forward, unless you got really something big coming off of the Middle East with the escalation really blowing up. But yeah, I just think, if the positioning gets back into a neutral posture, you should see a little bit of a sideways action next week. So my main disposition right now would be neutral with, a time horizon of 3, 4, 5 days, and we're going to see what's going to happen. The problem with these geopolitical events is always that the market tends to sometimes overreact, and then when the dust settles down, you see that everyone kind of wake up and say, well, but was a little bit of a big nothing burger at the end of it. So it's business as usual. Let's get back to the real economic data and the real fundamentals of the economy. Let's see if we should expect oil to go up or down. So that's it for oil. Let's just check the break evens for oil. Let's zoom in a little bit if we can. As you can see, I was looking at these highs, if you remember, and it looks like the trend, at least if you want to compare it to a price action chart, let's just say the relevant highs have not been taken out or broken. So for now, even looking at these, I would expect a little bit of a choppy. That's it for oil. I don't think that there's really anything else I could add to it, right? Let's go back to Bitcoin. And Bitcoin actually, gotta be honest, it surprised me. Now, I was under the impression that we would have, from the start of the week, we would have pulled back a little bit, holding these levels, and maybe trying for a little bit of an upside. But it didn't, right? As you can see, it just shattered down with, again, the big catalyst of the week. We broke through what I was considering to be a little bit of a nice support, this cluster right here, this shelf, at least at first test. No, it just went down and down and down. And, at the very least, we found a little bit of a support at previous levels. It was resistance, resistance, it was broken out. Um, a little bit of a deeper test, like if you look at this level right here, it's basically what you got as support. So a bit below previous resistance. So not really a perfect flip. And I think again it's a little bit like oil at the current moment in time. I would expect it to see it a little bit choppy, or at least let's put it this way, right? Which is I think it's a little bit better. Instead of expecting this or that, just look at what it does. Let's say Monday, Tuesday, and I think it could be nice to see it. Let's imagine it as a range for this week, right? Let's say you created this new dealing range right here, right? So what you want to see is, can it actually break down, or can it actually move up off of this range? Now, if it moves up, now this level right here could provide a little bit of a resistance. But overall, if you see it starting to grind higher, I think, it might be that this time around it really clears these intermediate high and we get back to previous resistance. Now, the only problem I see with that, again, it's what's coming off with all the geopolitical tension. But I mean, again, it's a little bit of a, you can just toss a coin and saying, you know what, I don't know how to assess political events, so I'm just gonna assume that this is gonna play out this way, and I'm gonna assess my position and my trades accordingly. Well, I mean, you could, but I just think, just follow what price does, right? It's gonna show you what it's about to do, one way or the other. I guess even with this one, I would be particularly neutral. It's just not. It's not like I don't want to pick sides, right? It's just that when you see price action moving like these, what I guess your best bets are on establishing a little bit of price sensitive type of levels, like this one over here, or like we've seen in previous weeks, this one over here was one, and all in all, that's what you might want to do. Just not try, not trying to trade the direction, but just trying to highlight the recent pockets of liquidity left behind in the current price segment and trade off of them. Could be a little bit of a safe bet if you don't, or if you don't feel, let's put it this way, if you don't feel comfortable guessing the direction for the next week or month, which is basically where I'm at the current moment in time. With the oil coming up Of course, the yields had a little bit of an uptick, especially the 2 years, as you can see in here. So now again, this brings me to kind of the same point once again. Was about the geopolitical events that you've seen yields really bouncing like this, and of course, conversely, bonds having this little bit of a much more protracted pullback. I know people are already starting to call it just, this is it. The bond rally is over, yields, and therefore interest rates are set to go higher and higher into the future. Uh, it might be. I mean, I'm not absolutely ruling that out, but as usual, I just want to try to offer a little bit of a different type of a perspective. If you look, we had a massive run up in bonds prices. I'm looking at the ETFs now. Basically, it started out at the end of July, and it got the last hooray, let's call it like that, for at the current moment in time. We don't know what's going to happen into the future. So if you remember, so this is September the 4th, or yeah, yeah, three. So the third, the fourth. Anyway, basically 2 weeks in advance compared to what was supposedly the moment where the Fed finally should have pivoted, which was September the 18th. So again, I'm just long story short, these weakness we are seeing in bonds prices might just be a kind of a sell the news event. Like everyone basically was betting that the Fed would have cut, and everyone was buying bonds in anticipation of it. But if the type of price action you expect coming off of a rate cut is already in the chart before the actual cut, it's kind of a little bit of the same logic. If everyone which was willing to buy the narrative of rates being cut has already bought ahead of the actual cut, what's going to happen when the cut comes? If everyone has already bought, uh, there's no one left to buy, and people are just going to start to sell the news. They bought the rumor, they might have sold the news, so this could explain what we've seen in bonds. Of course, there is still the September effect of, although we are in October, but as I said, the effect, the phenomenon goes out from the last week of August to the first 2 weeks of October. And if you look at previous cycles, and I'm talking about rate cutting cycles, even in 2000, basically the dot-com bubble, and 2008, the cuts weren't always, carried on the same way. Like for instance, I'm just going off of my memory, right? So forgive me as the data are not gonna be particularly accurate, but I guess Greenspan, he went for initially two 25 basis points, and then he went for like 3 or 4 50 basis points, and if you compare to what happens, let's say with Bernanke in 2008, he initially went for I think 250, then he paused a little bit and he made a bunch of 25 basis points, and then he really went for like 75, 50, 75 again, and he dropped down to zero. So don't expect every rate cutting cycle to be exactly the same, and don't don't try to really anticipate what you think the market is going to do, especially like in this case if you see that most of what you were expecting has already happened. Just be aware of that, right? So let's have a look. Well, of course, the current movements kind of brought the 10-year, so the yield curve, to drop back a bit. It was steepening out and it dropped back a little bit. If you remember, this is nothing new, right? I mean, I'm just saying it can happen, right? If you look, I'm trying to zoom out without completely messing up the chart. Let's see. I'm probably gonna do a terrible job at it. Yeah, if you look at previous inversions, like in the 90s, we got the initial pop, then it gets back down, and then finally goes. If you look at 2008, the financial crisis, pops up, comes back lower, then it pops up again, retests the zero line, so to speak, and then it goes. So, again, just be mindful of, again, the old cliche: markets don't go in a straight line. So I don't think fundamentally something has really changed. When it comes down to what yields and interest rates should kind of price in, which is future growth and inflation expectations. But short-term fluctuations are always out there, around the corner. So just be aware of that. I think we should now transition to equities. Um, and even in here, I changed the disposition a bit, the layout a bit. Now you've seen on the top left the NQ futures, on the top right the Dow futures, on the left bottom E-mini for the S&P, and on the right bottom I added in these small cap. Basically, this is the Russell 2000. If you zoom out a little bit, you see a little bit of one and the same. Still got the S&P being relatively stronger than the Nasdaq. The Dow, I guess, is scoring all-time highs at the current moment in time. Yeah. So it's not, and of course the small caps, they had these, looks like a massive trading range right in here, but I when I zoom out on these, I always see how the small caps tend to just lag and underperform. But this is just a function of how the market and the money flows are structured into these asset classes, right? And also, how the companies, which are the underlying fundamental value of these equities, or at least that they should be, are structured. You would expect, big hubs to have much more money, much more ability to, take out loans, perform corporate shares buybacks and whatnot. So the bid for the big hubs is always there, and of course they can actually grow revenues. So therefore, influencing the price to earning ratio, and therefore the stock evaluation should be bigger, and so on and so forth. So I'm not surprised to see small caps actually underperforming. What I'm still a little bit, I'm not gonna say surprised, but kind of bugged. It's what still bugs me is the fact that the S&P is leading and the Nasdaq it's just lagging. So this is still something which brings me to be a little bit more cautious, I guess. But at the same time, I'm going to repeat what I said in the last week episode. This is still looking bullish. We tested kinda almost the 20 days moving average right here, and we came back up off of it. So what if you are bullish? The premise is that you are bullish. What you want to see is this thing now trying to grind higher once again. It doesn't have to be a sharp move like you've seen in here, 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 or here with a V-shaped recovery after the carry trade debacle in August, but even a nice movement to the upside could be good. Could we chop around this region a little bit? Yeah, we could. But up until the point you can maintain price action above mainly the 20 days moving average, I'd say, but most importantly the 50, I think we are all good to have a short to medium term bullish disposition on these asset classes. So I would keep on being relatively bullish overall, with the caveat that, of course, we have talked a lot about how the fundamentals are deteriorating a little bit, how geopolitical events could impact. Still, bear in mind, you trade the market you see, and macroeconomics, uh, data points, and indicators, they're gonna take a lot of time to be manifested on the charts. And then, of course, you you have to account for the fact that we are cooking the books, there are elections and whatnot. So, guess this is it, right? Just be aware of that, and no matter what you think, always remind yourself that the market is always right and you're always wrong. So if the price action is bullish, you need to have a bullish disposition. That's it for now. Don't have well, yeah, I got these for the last month since we are at the beginning of the month of October. We just had the first trading week of October. So let's look at what the previous month was in terms of the sector tracker. You see that it's positive enough. I mean, compared to what it was just I remember at the end of August and whatnot, right? It looks like consumer staples came down, and you got discretionary communications, technology actually performing relatively good. So I again, it's not like the market is never gonna pull back. I just don't think, and again, week by week, I just don't think it's gonna be a violent pullback right here, right now. The risk is always there, and there are many factors of risk, but not in the immediate time horizon. So that's where I would left it. Leave it probably. Yeah. I don't have a lot of charts. Again, it's a matter of time, but I just quickly wanted to show you these. So this is the gains, the percentage gains from August across different asset classes. And as you can see, every single thing is going up. And China, I guess this is a bit. I don't think this is up to date. The Chinese number should be way higher than that since the massive rally we've seen in the Chinese stock market. But just to give you the gist of it, you see that everything is going up, which to some degree it's a positive. It basically shows you that no matter where you put your money, you're having positive returns, right? I think they've called it the everything market. It was in an article I've read. I don't remember the author though. I mean, it was an interview basically to a relatively famous money manager, hedge funder. Maybe it was Paulson. Sorry, I don't remember that. But anyway, it shows you that in what is supposed, and again, big emphasis, I'm supposed, right? What is supposed to be the last phase of a huge bull market, everything starts to go out to go up at the same time. It's kind of your parabolic blow off top, if you wish. So up until this condition stays, you should have a bullish disposition. Now, it could go on for 6 months to a year, so we don't know when it's going to end. What we do know is that for now, this is the situation. And you might ask, why? Why is it? Well, again, a lot of people are going to check these and say, yeah, that's the reason for it. The money supply is going up. The Fed, the ECB, the Bank of China now, the BOJ, everyone is printing money, and these money have to find uh, something or somewhere to go to, and of course they go into asset classes, right? So this is why the price is always bid higher and higher and higher. Yeah, I think it's a thesis which could stick. Um, the the only What I find particularly interesting about theses and explanations and narratives right now is that in this type of market, right, whatever type of narrative you want to put on it, you're right. Yeah, because the simple fact, let's use a practical example, right? I think stocks are gonna go up because XYZ, money printing, elections, they want to cook the books, or um, soft landing or whatnot. All right. I think gold is gonna go up because they are already pricing in interest rates cuts, therefore more money debasement into the future. Or let's say gold is going to go up because counterparty risk, the market is looking at something which it's not particularly cool, or maybe are the BRICS which are stockpiling on gold because they want to, deviate and divorce from the dollar system, whatever. All these explanations, all these reasons are actually validated by the market. But by the simple fact, the price is going higher, right? So you're not necessarily right just because the market is going higher and you are trying to find a good reason for it. Because at that point you could say, here's an extreme. The market is going up because the moon is made out of cheese. Yeah, okay. Try to disprove that. You can't. You can't because it is a true statement at the current moment in time. Because the market is going up, and I say the market is going up because the moon is made out of cheese. How could you disprove that if the market is going up, right? Again, it's just an extreme example. Of course, the moon is not made out of cheese, but it was just to deliver the message. So it looks like 2024, it's gonna be, you know, how would you define it? Yeah, as for the titles, one of the biggest month of monetary easing since the pandemic, basically. So again, that brings in the fact that a lot of liquidity is injected into markets right now, and it has to find a way a place to go to, right? And if you check 2024, now there is no title here, but I'm gonna tell you, these are the inflows in global ATFs or asset classes, right? For 2024. And it looks like this is going to go on record to be the second biggest year when it comes down to inflows in financial markets. And then you ask why everything looks so bullish, although the economy doesn't look so healthy. Well, that's your reason. It's always a matter of flow, right? Up until the moment money stops to come in, you should expect asset prices to go higher. Of course, over a long period of time. It's not like just because you see a pullback in the Nasdaq tomorrow or next week and it drops by 1%. Ah, see that? That's over. It's over, guys. The bull market, the bear market is here. No. Uh, but if you zoom out a little bit, you look at the daily, you look at the weekly, that's kind of the trend that we have seen throughout this past year. 2024 is almost over at this point. Now look at that. This is particularly interesting. You see that basically it looks like everyone is allocated. Like, I mean, really, uh, everyone is trying to chase something. Um, so, you know, if if you think that the market is going up and you have to participate into it, you're gonna do what? Trim down your cash positions. At this point, trim down. I guess I guess that it's what they deem as bonds. I would assume, but maybe not. Let's say that's how I would see it because you drop bonds because now you have better returns in stocks instead of staying in bonds and collecting the coupons as it was ever a good investment strategy. But anyway, I would I would expect that that debt is related to treasuries and bonds, but it just shows you that everyone is kind of allocating into these markets because they want to benefit from the upside. And that brings another important point. Now, if you think about mom and pop or the retail individual investor, as an individual investor, you have the luxury, so to speak, to say, you know what, I don't like what I'm seeing. I'm gonna stay in cash, or at least I'm gonna allocate. I'm gonna take more. I'm gonna keep more cash on the sideline, a little bit of a dry powder, right? But if you are a money manager, ATF manager, or mutual fund, pension funds, whatever you, if people throw money at you, you have to put those money to work. Because if you don't do that, if you miss out, and if you underperform, let's say the index, the benchmark returns, what's going to happen is next year those clients are going to take those money and bring them to someone else, which was, and forgive the abusive language here, a little less of a pussy. So that's career risk out there. People which are managing huge amount of monies for other people, they need to be allocated. They need to participate. Otherwise, they're gonna go out of business. And again, that just fuels these chase of asset prices higher and higher and higher, right? Also, if you think about supply and demand dynamics, that I didn't know that, but that was actually mind blowing. If you look from the late 90s, early 2000s, it looks like the number of publicly traded companies has just shrinked by 50%, more or less. So again, more money coming in and less assets to be chased. Supply and demand. This is why stocks over a long period of time tends to go up, ain't it? Right? But it's not only stocks. Look at this is basically the production of gold in the last 13 years. Now you see it went up until 2019, 2020, and then it started to trend a little bit. I mean, it's not a huge, reversal or a downtrend, right? But you see that still we got lower numbers, which means that we are extracting less gold compared to pre 2020 type of levels. And of course, gold is going up. Now, the problem with it, and this is just getting a little bit into the technicals. On the top, I think there should be, this is look like an RSI, should be a relative strength index. And on the bottom, we got what it looks to be a MACD, right? If you are familiar with those. What's on the chart, actually? Now, this is, I guess, a monthly chart, if I'm reading it correctly. So the the moving average should be the 4-year moving average, I guess. Yeah, if I remember, yeah, on a monthly chart. And we are basically trading at two, probably three standard deviations far away from it. And you see what happened. This just shows you basically mean reversion over a longer period of time. You see every time we have been deviated out from long-term moving averages, at a point price had to mean revert and get back to them. And coincidentally, those periods kind of coincide with, let's say, the panic of 87, the dot-com bubble right in here in 2000, 2008 financial crisis, uh, 2015-16 European sovereign debt crisis, and then of course you got your COVID, the pandemic, and 2022 there was, I guess, I mean, you could call it the Russia-Ukraine war or recession fears over the US, right? So again, prices are massively extended to the upside, and that goes for stocks and for gold. It's the same type of a chart for gold. I guess we are looking at 3, 4 standard deviations away of long-term moving averages here. Now, what or where is the catch? The catch is that you never know how long this price action is going to be dragged out into the future. If you look at these, the kind of extreme reads were starting to manifest themselves in 2020. No, what was that? 2002, but it went on for like 6 years before having a decent reversion. So again, it it just tells you that we are in an everything market basically, and everything is going up. And at a point, it's gonna pull back, but you just don't know when. Let's just say you could use, I mean, if you look at the long term, you could use this type of analysis to come up with good opportunities to accumulate the assets you like, I guess. So just bear in mind that although we are at extremes, you never know when the reversal is going to happen. That's the premise of it, and that's all you need to know. Which is why I keep on saying you trade the market, you don't trade what you think, and you don't trade whatever type of narrative you think is actually playing out right here, right now. Okay? What's interesting is that if you look at recent times, it looks like the gold correlation to equities is actually getting really, really positive. We are at 0.83. So gold is actually trading like equities. It's a risk on asset. Would, would you believe that? I mean, I don't think it is fundamentally. I'm just saying it's behaving like one, right? And if you look back, it's not the first time you've seen something like it. So basically, the the thicker line is gold, right? And this wider ranging type of line is the correlation read. So you see, if you know how it works, basically, if it is at zero, there is no correlation. If it is negative, there is a negative correlation. If it is positive, there is a positive correlation. Um, and let's take the positive one. The more positive it is, the more one asset it's following the other in locksteps. So basically, if you got one-to-one correlation, it says that if asset A goes up 1 point, asset B goes up 1 point. They are basically tracking each other, right? So it just shows you the degree of correlation from 0 to 1, from 0 to -1. And you see that even back in history, we got periods where gold was particularly correlated to stocks. Now, if you look though, the higher reads oftentimes they are kind of the, let's say, the precursor to nice corrections into gold prices, right? Like in here and in here. And I mean, you can just read the chart, right? So, what? Where am I going to? I'm just saying that if everything is so distorted, it's so quote unquote fucked up that even gold is behaving like a risk on asset, it just shows you that it's pointless to keep on trying to nail the top to short the market. All right. Again, I'm just bringing on examples on examples on examples to kind of give you a little bit of a perspective. it's fair if you want to go out and scan whatever thing you can scan in order to find risks. This is what I do. Don't get me wrong. I want to be aware of the risks, but at the same time, you don't want to impose your view on the markets and on the current price action, right? So I guess that's it. Got anything else? I got just one final thing, which is this. You think that just because we look at the economic calendar, because we got a narrative and whatnot, you think that one could actually assess current market behavior and interpreting the data flow coming in, and being able to to make money, right? Now, of course, we do know that in reality, it's not like that because you don't know what type of data are gonna come in, you don't know how the market is gonna react to it, and so it's always a guessing game. But guess what? There is this interesting article right here. It's more of a blog post, right? And you can find it at www.elmwealth.com/crystal ball. So basically, this is sort of a test. It's a game. You can do it too, right? You just there will be the link to the challenge in the page. What they've done, and you got a nice tweet from Nassim Taleb in here. What they've done is basically they created a simulation where the people taking the test, they could have access to what the headline would have been 24 or 36 hours ahead of time. So basically, you see the future, right? You see what the data point is going to be. And based on that, they could, they had a little bit, a simulated portfolio. I think it was, let's see, I guess 1 million, maybe? Yeah, yeah. And they could have decided to go long or short, both, or, even actually both of them at the same time, or just one at a time, but they could have taken trades or opened up position on the S&P 500 and 30 years treasuries with, of course, the amount of leverage they wanted, right? Based on the news, they did have access to basically a day ahead of time. What's really incredible about this is that the test was brought up to, I guess they were 118 um, financial students. So basically, people which were trained in financial type of matters or subjects, right? That could be your classic econ student or your I don't know if it could be a business school type of a student, but anyway, people which had training in financial matters. And the shocking result is that a lot of them actually lost money, even by having the data point ahead of time. Then they put under the same test experienced macro traders, could be hedge fund managers or just macro traders like the I'm not saying that the Druckenmiller tires, but anyway, the results were nice because what you see is that although people really didn't get the direction right compared to what the data point was, but the difference in between the students, so what you could deem as your retail investor, and what the experienced investor, the main difference was that the big guys, so to speak, they made more money because they were able to adjust their size better. So they really went on, they went balls deep on stuff they had a lot of confidence betting on, and they took a hell of a lot of less risk on stuff they weren't so quote unquote certain of. And overall, that just shows you that even if you got the data in advance, the market is probably not going to react the way you expect just because this number comes out or that numbers comes out, right? It's a nice article if you want to read that. I highly suggest that you do. It's enlightening to see because no matter how much and how long we can talk, there's always many ways by which the market could surprise us. Again, just last example, right? Hey, Fed cut on September 18th. Fed cut. Hey, this is a bottom in yields, and yields goes up. I suppose if the Fed is cutting rates, yields should go down, right? Right? So again, it was an interesting topic. Now I already talked enough. I'm really getting out of time right here. So man, this is incredible. 55 minutes in. Can't really shut my mouth off. So with that being said, have a nice rest of your Sunday, and let's get ready to next week. It's gonna be cool to see how these all situation, so to speak, between Middle East elections, markets going up or down. It's going to be interesting how it unfolds itself, especially in the month of October, which will bring us to the actual elections week. As usual, uh, be nice and be cool. Neil's out.